Hello there. The final part of Lecture Series 16 looks at the disclosure requirements as set out in IFRS 8 Operating Segments. IFRS 8 requires an entity to disclose the following general information. 1. Factors used to identify reportable segments. This shall include the judgments made by management in applying the aggregation criteria if two or more operating segments are combined. 2. Types of products and services from which each reportable segment derives its revenue. IFRS 8 also requires the following disclosures for each reportable segment: a measure of profit or loss. This shall include the following: 1. Both internal and external revenues. 2. Interest income and interest expense. This shall not be netted off unless the majority of the segment's revenue are from interest and the chief operating decision maker relies primarily on net interest revenue to assess performance and make decisions on resource allocations. 3. Depreciation and amortization. 4. Other material item of income and expenses. 5. Income tax expense or income. 6. An entity's interest in the profit or loss of associates and joint ventures, accounted for by the equity method. Next, a measure of total assets. This includes 1. The amount of investments in associates and joint ventures, accounted for by the equity method. 2. The amounts of additions to non-current assets other than financial instruments, deferred tax, net defined benefit assets, and rights arising from insurance contracts. Please be reminded, although a specified amount is not included in the measure of profit or loss or measure of total assets, if they are regularly provided to the chief operating decision maker, then it shall be disclosed. Finally, an entity should provide reconciliation of total segment revenues, reported profit or loss, assets, liabilities, and other material items to its corresponding total amounts. IFRS 8 disclosure requirements are relatively cheap for entities to comply with, given the information is already produced for internal use. Thus, the benefits of this information exceeds the cost. The benefits include: 1. Investors have access to how management views the business, as segmental reports are produced from a management perspective. 2. Assessing segmental reports allows investors to understand growth rates of different components of an entity and therefore helps investors to better predict future performance and cash flows. 3. Segmental information by geographical locations are especially useful for investors of multinational businesses to have a better understanding of risks and growth rates. This concludes Lecture Series 16 on IFRS 8 Operating Segments, covering the following areas: 1. Scope of IFRS 8. 2. Definition of operating segments. 3. Reportable segments. 4. Aggregation criteria when combining two or more operating segments. 5. Quantitative thresholds. And finally, disclosures. The next bite-sized corporate reporting lecture series will look at IAS 24 related party disclosures. Till my next lecture series, thank you and have a pleasant day.